You send money, the app confirms it, the button turns gray. A small word appears on the screen. Pending, nothing failed, nothing broke, nothing is missing. You're just waiting. Here's the part most people don't question. Waiting feels passive. It feels like nothing is happening. But something is happening. Most people assume this delay is accidental, a technical limitation, outdated software, a slow system catching up to modern expectations. That assumption feels reasonable. After all, everything else in your life is instant. Messages, photos, location. Money should be the easiest thing to move. That assumption is wrong. Banks are not slow, they are careful. And waiting is not a flaw, it's the point. What looks like a pause is actually a filter. There's a story people tell themselves about banks. That they're old, that they're bureaucratic, that they're trapped inside legacy systems they don't know how to replace. This story is comforting, because if banks are slow, then no one is really in control. But this story collapses under the smallest amount of pressure. Banks move billions of dollars every single day. Markets settle enormous trades in fractions of a second. Entire financial systems rebalance continuously, globally, without pause. High-frequency trading exists. Real-time settlement exists. Central banks move liquidity instantly when stability is threatened. Speed exists. It's just not distributed equally, and that inequality is intentional. The question isn't why money is slow. The question is why speed is rationed. When you move money, nothing physically travels anywhere. No bills move, no coins change hands. What changes is a ledger. A bank transfer is not money moving from point A to point B. It is a promise, followed later by settlement. That difference sounds technical. It isn't. Everything depends on it. First, the system records intent. Then it checks availability. Then it waits. Then, eventually, it settles. That waiting period is not empty time. It's a decision window. The delay is not confusion, it's sequencing. And sequencing is where risk lives. Money doesn't move until the system decides it's safe to let it move. This distinction matters more than most people realize. When your app says sent, what it really means is authorized. Authorization says, we acknowledge the request. Settlement says, the money is now final. Between those two moments is a window of time where the system watches behavior. That window is not idle. It is economically useful. During this window, banks are not waiting. They are observing flows. They are netting obligations. They are measuring aggregate movement across thousands of accounts. Your transfer is not evaluated alone. It is evaluated as part of a pattern. And patterns, not people, are what the system understands best. This is where you disappear into statistics. That window has a name, float. Float is the time between when money leaves one account and when it becomes fully settled elsewhere. During float, the money is not gone. It's not fully arrived. It exists in between. At an individual level, float feels trivial. Minutes, hours, sometimes days. At a system level, float is enormous. Across millions of transactions, float becomes liquidity. Liquidity becomes flexibility. Flexibility becomes stability. Even a few hours of float across a national banking system represents billions in temporary usable funds. This liquidity absorbs shocks quietly. Without alerts, without headlines, banks don't eliminate float because float buys time, and time is the most valuable resource in a financial system. Without float, every imbalance becomes immediate. Immediate problems don't stay small. Most people think banks fear withdrawals. They don't. Banks fear synchronization. One person moving money is harmless. 10,000 people moving money at once is noise. Millions moving money simultaneously is a crisis. Speed compresses time. Compressed time removes choice. Delays stretch time back out. They stagger exits. They slow cascades. They prevent panic from becoming momentum. Waiting is not punishment, it's insulation. The system isn't designed to stop movement. It's designed to prevent movement from aligning. Alignment is what breaks systems. Instant transfers feel fair, but fairness is not the system's priority. Stability is. If all money moved instantly, liquidity buffers would collapse. Timing risk would spike. Small shocks would amplify. A rumor becomes a run. A warning becomes a wave. A precaution becomes a cascade. Delays turn sharp movements into smooth curves. And smooth curves are survivable. Instant systems fail loudly. Delayed systems fail quietly. Quiet failure is preferable. The system chooses silence over speed. This is where people notice something uncomfortable. Some transfers are instant. internal transfers, small amounts, certain users, certain accounts. That's not inconsistency, that's risk pricing. Speed is not a feature, it's a privilege. The more predictable you are, the less dangerous your movement becomes. The less dangerous your movement becomes, the faster the system allows it. Predictable income, stable balances, low volatility behavior. This is not personal, it's statistical. What feels like convenience is often trust earned through predictability. Look closely at the language banks use. Processing, pending, under review, available tomorrow. Clears in 1 to 3 business days. None of these mean we don't know. They mean we are spacing you out. Friction is how systems stay liquid without appearing fragile. Limits slow acceleration. Holds dampen spikes. Delays distribute pressure over time. If everything were instant, fragility would be visible. Delays hide stress. Smooth surfaces often conceal tension underneath. This is not tradition, it's containment. Batching transactions into windows allows banks to net obligations, reduce exposure, manage liquidity centrally. Continuous settlement increases volatility. Windows reduce it. The calendar itself becomes a stabilizer. Time is not neutral in banking. Time is an instrument. This is not a conspiracy. Regulators prefer slower money. Delays reduce panic. Delays allow oversight. Delays prevent feedback loops. A system that moves too fast breaks publicly. A system that moves slowly breaks quietly. Quiet failure is preferable. Speed is restricted not because it is impossible, but because it is destabilizing when universally available. Some people notice they wait less. Their transfers clear faster. Their limits are higher. Their holds are shorter. This isn't favoritism, it's predictability, stable inflows, consistent balances, low volatility behavior. The system rewards what it can model. What it cannot model, it slows. Transfers don't feel slow because banks are incompetent. They feel slow because speed is the most expensive thing a financial system can offer. Time is how risk is priced. Delays are how movement is measured. What feels like inefficiency is often restraint. What feels outdated is often intentional, and somewhere along the way, the product changed. The account is no longer the product. Behavior is. Movement is measured. Timing is modeled. Patterns are priced. Your transfer didn't fail. It waited. Because the system cares less about where money goes than when everyone tries to move it at the same time. If this made you uncomfortable, that's expected. Systems don't reveal themselves through outrage. They reveal themselves through incentives. Banking doesn't fail because people behave badly. It works because people behave predictably. Once you understand the system, you stop taking its outcomes personally. In this series, we don't give advice. We explain how the machine works. If you want to keep seeing how everyday systems actually operate, subscribe. Because clarity isn't empowerment, it's orientation. In the next episode, we'll look at why your credit score isn't about trust, and never was. This channel isn't about finance. It's about systems hiding in plain sight. See you next time.